Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Risk waivers, the stock 600 edges lower amid growing recession fears. But the Hang Seng Tech, of course, closes nearly 7% higher following steps by Hong Kong to relax COVID curbs. Nuclear risks, Vladimir Putin warns the threat of nuclear war is rising and says conflict in Ukraine may be prolonged. Plus, tech curbs, Dutch officials plan new controls on exports of chip-making equipment to China. We'll see how European chip makers begin the trading session in just a moment. Now, first thing is first, so let's check on the markets to see how they're doing today. They were kind of trading sideways a little bit. Now, the focus, of course, firmly on what's happening in China. Some of the concerns also about the inverted yield curve in the U.S. Now, European equities seem to be inching lower than a couple of other things we're watching. Euro rising slightly, the pound little change, treasury yields rising after a sharp decline in prior sessions. The other thing we're watching out for, of course, is chip makers, and this is after we had some news when it comes to, for example, the Dutch and what they're doing with some of coming up, well, bringing back some of the chip-making equipment, or certainly not doing peace with China when it comes to some of the components. And you can see ASML down 0.4%. Now, stocks fluctuating following signs that China would further relax its COVID restrictions, while treasuries flashed warning signs of recession. We're now joined by Zeynep Öztürk-Onlu, the Chief Investment Officer for EMEA at Deutsche Bank Private Bank. So thank you so much for joining us. I mean, if you look at what the market is telling us, I don't know whether you need the inverted yield curve to tell you there's an impending recession, and therefore, how do you manage a portfolio?
I don't think we need an inverted curve to tell us that there is a recession, but it is an extremely important sign to showcase that, yes, the markets are now realizing and pricing the recession way more than it was before. Our expectation has always been that there will be a recession, however mild it will be. But markets weren't really reacting that much on it, especially in the US. Europe has already been in recession in the fourth quarter. And now, for the last couple of days, we see that the U.S. Treasuries, especially the way it has been reacting on the 2 and the 10 spreads, it is quite clear that the realization is there.
So what does it mean, Zeynep, in terms of, do you buy any treasuries at this point, or is it just too all over the place?
It is too all over the place, to be fair. We have been looking into the sovereign and rates for quite a while with a very cautious approach, but I think it will be a little bit more bumpy from here all the way till the most initial part of the new year. So we're very cautious on that.
And equity markets, and I'm hearing everything from a correction. I mean, we had Nouriel Roubini yesterday. I know he's Dr. Doom, and he was saying, look, we're going to see a 25% correction when it comes to S&P. Today, our previous guest was saying there's going to be a 10% correction. How difficult is it to call bottom?
It isn't easy, and this is a kind of a phenomena that we have been talking about. It's not easy to time the market, so you shouldn't time the market, especially in our industry. When you have a long bias on your portfolios, you need to start thinking from a mid to longer term, and trying to time based on the action that has happened over the last couple of months. Trying to build a portfolio based on that for a longer term isn't healthy. Therefore, we do take action, or we do look after portfolios in order to take advantage of some of the bear market rallies. But in order to build a longer term view, we try to zoom out and see how we can really analyze the performance.
So where do you see value right now?
In equities, it's an area where we look more into the sectors that had the biggest sell-off, but why the sell-off has happened, how the devaluations been impacted. For example, Europe has been more undervalued than US, so we look into European market more favorable on a longer term compared to the US equities. There are good values in certain parts of the UK because of, again, the significant devaluation of the industry.
Which ones? Is this really just because it's cheap at the moment, or because you see potential for growth that has been lost in the mess?
There will be on the mid to longer term, but initial part of the early next year will be quite bumpy for UK because of the negative growth concerns that we're already in recession. There are a lot of negative news coming in the market, but on a longer term, there are good values because of the fact that the sterling has really depreciated significantly due to this stronger dollar, and certain UK sectors with their outside of the UK business that they've done will benefit from the undervaluation.
Zainab, we're just getting some breaking news out of Trafigura. This is, of course, a commodity trader posting a record $7 billion in profit. I mean, they've had a really pretty amazing blowout year. This is as a commodity trader cashed in on this wild price in, for example, arbitrage opportunities. And this is because of Russia's invasion, of course, of Ukraine. What do you do with some, I mean, we look at the oil majors, they're doing very well. You see companies up as Trafigura. How do you play it? Do you get involved in those?
We don't get involved too much in energy, to be fair. Most of our portfolios are ESG focused. That is one of the main criteria. But beyond that, there has been so much volatility and so much uncertainty in energy in particular. What we see happening in oil is a great sign for it. It has already been flat year to date in terms of return, but there have been a significant performance on most of the energy companies, so we cannot ignore that as well. Hence, there is, if any, a relatively selective positioning there. What we will see with the China reopening plan and oil not reacting enough as yet, what will happen with the oil price cap in the coming months and the reaction of Russia's production. Will OPEC Plus further react to all of these? There are so many criteria and so many variables to watch on that.
Zainab, how do you look at currency fluctuations? So again, they could be quite a shock if you have a big position in a sector. Are you expecting much more volatility? Will currency volatility be even greater than equity volatility in 2023?
I think it can be, mainly for the fact that we had this extremely strong dollar year in 2022, but it has been kind of, I wouldn't say awakening, but balancing out a little bit more over the last couple of weeks and months. But anything that comes from a geopolitical risk always has an upside in dollar as a risk, hence this can create additional volatility. On currencies, our view both on euro and GBP in particular is relatively balanced, so we don't expect a major outperformance of currencies in general term.
And in terms of what that means for emerging markets, again, you're mentioning dollar strength. Are there any opportunities in specific countries?
LATAM in particular has been performing extremely well compared to what has been happening, especially in a high interest rate environment and a very strong dollar, with an ease of dollar a little bit more. And if this continues like this in the first part of the next year in particular, this can have also another positive impact on LATAM currencies.
Okay, Zainab, and I'm looking at the 60-40 portfolio. I mean, is it ever going to make a comeback?
We are of the opinion that it will, because last year and the year before there weren't any relevance of the 60-40 in a way. We were having quite a high beta market for a very long time, and it didn't matter where you were at 80-20, 60-40. But now I think the core focus with a sustainable income through fixed income and not completely shying away from risky asset with a certain allocation on equities, 60-40 becomes more meaningful.
And I think the story probably that dominated this week was definitely China, the reopening of China. And there are about half of the people we speak to that believe there will be a full reopening by March, April next year. And those that doubt or see a kind of stop and start situation when it comes to COVID zero. Does it make a difference for how you build a portfolio, and how do you play China?
It does, but our base view has always been that China will gradually start opening. It won't be from one day to another, or it won't be from February to March. I think it will be the ongoing 2023 theme, and this was our base case. So China is such an important market that you cannot ignore away from your portfolios. And where we will look into going forward is more broad-based China index rather than anything specific, in order not to take any view due to the volatility that we will be through during this opening phase.
All right, Zainab, thank you so much for coming on today. Zainab Öztürk-Ünlü there, the Chief Investment Officer for EMEA at Deutsche Bank Private Bank. Now, coming up, rolling out the red carpet, President Xi arrives in Saudi Arabia, a trip marking the region's deep and growing ties with Beijing. We'll have plenty more on that story next. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Chinese and Saudi companies have signed investment pacts for green hydrogen and solar energy during a visit of Chinese President Xi Jinping to the kingdom. The trip marks the region's deep and growing ties with Beijing as U.S. relations come under pressure. Now, let's get more with Bloomberg's Youssef Gameldine. Youssef, so tell us a little bit more about the visit and what these deals actually mean.
Well, Francine, there's a lot being made about a potential pivot, a shift from Saudi Arabia away from the United States towards China. But that doesn't quite tell the story because China and Saudi Arabia have very deep economic and political relations. $90 billion almost was the total bilateral trade flow in 2021. The United States just amounts to a third of that. Much of the trade is centered around energy. In the United States, it's a relationship around maintaining the Saudi military umbrella, defense sales, and absolutely crucial in safeguarding the security of Saudi Arabia. Now, we understand these deals have been signed, the 34 of them. They're centered around IT, healthcare, logistics. What I would watch is when these deals start encroaching into typically U.S. domain. So maybe on the side of military drones, 5G networks is another one. We understand just in the last few moments, the Chinese president is on his way to Al Yamama Palace in Riyadh. He's going to sit down with senior royals, including the Saudi Crown Prince Mohammed bin Salman.
Yep.
Probably we're not going to get the awkward fist bump that we got with the U.S. president, but we will be, of course, across it all throughout the day and into tomorrow. Fran.
So what does it mean, Youssef? What does each, I guess, side need from the other?
Well, basically, from the Saudi side, it is about making sure that they have other options. So this is a message to the United States that it's no longer just about them, and it is about safeguarding their future. And so this is just part of an old Cold War tactic, right? If you have two superpowers, you kind of play the two against each other and see who can come up with the sweeter deal. The Saudis are going to be very keen to get deeper Chinese involvement in areas that lead them closer to the broader Vision 2030, the transformation of the kingdom away from a reliance on fossil fuels to a more sustainable future. And that's going to be something we're watching throughout this Thursday. There's just so much at stake here. And I think much more importantly, the Saudis are sending the world a message that they are now on the front lines as one of the largest oil exporters, and they're going to play with that leverage across the board. Fran.
Yeah, they certainly are. Youssef, thanks so much. Youssef Gameldine, their anchor in Dubai. Now, let's stay on China. And Kinnevik chairman James Anderson says President Xi has killed off opportunities for tech investors.
I don't think killed the tech dream, but I think he may have killed something which is critically important for technology investors, which is the extreme upside. You know, effectively, it seems a lot of this is saying you can get big but not too big. You can get dominant but not too dominant.
That was Kinnevik chairman James Anderson speaking, of course, to our Tom McKenzie. Now, coming up, President Vladimir Putin warns that the threat of nuclear war in the world is rising, calling Moscow's nuclear weapons a deterrent factor. We get more on that next, and this is Bloomberg. Welcome back, and let's get back to the Bloomberg. First Word News, a senior health advisor is warning that the vast majority of China's population may eventually contract COVID-19. Now, this comes as Beijing makes concerted steps towards dismantling its zero-tolerance approach to the virus. Meanwhile, local media reports in Hong Kong say the city is preparing to ditch its outdoor mask mandate. Now, scrapping PCR tests for inbound travelers is also said to be under consideration. The EU has announced a ninth package of sanctions against Russia, including restrictions on access to drones, chemicals and military technologies. Now, the measures, which need the backing of all member states, come hours after President Putin warned that the threat of nuclear war in the world is rising. The Russian leader said his country will defend itself, quote, with all means necessary. Vanguard is leaving the world's largest climate finance alliance. Now, the asset management giant says withdrawing from the Net Zero Asset Managers Initiative, spearheaded by former BOE Governor Mark Carney, will help provide the clarity our investors desire. Now, the move also comes as U.S. Republicans continue to step up their threats against firms deemed hostile towards fossil fuel industry. And sources say Dutch officials are planning new controls on exports of chip-making equipment to China. The measures would align the country's trade rules with U.S. efforts to restrict Beijing's access to high-end technology and could come as soon as next month. Now, the Netherlands is home to ASML, one of the world's most important suppliers of advanced chip-making machines. Well, Bloomberg has also learned that banks, which backed Elon Musk's Twitter takeover, are considering providing him with new margin loans backed by Tesla stock. Our Bloomberg Markets correspondent, Kriti Gupta, has all of the details. Kriti, I'm absolutely fascinated by the story, one of our most top-read. And we know, of course, of the linkage, but this is actually quite a special deal. So how does it work?
Quite a special deal, quite a lot of money at risk here.
A lot of money.
A lot of money. Now, this is a $44 billion acquisition, 13 of which was originally financed by Twitter debt. And that's not just your issuance, your traditional issuance. This is debt that's 11.25%. So to put that in context, issuance right now in the U.S. is about 5%. So there is a massive risk premium right now baked into this debt. What's worse, though, is that a lot of the banks behind it, like Morgan Stanley, SocGen, they're not actually able to unload it. Nobody wants to hold on to this debt because of this Elon Musk saga and essentially the drop that Twitter has actually had in terms of profitability and issues like that, not to mention, of course, the stories surrounding and the layoffs surrounding what's going on in Twitter. So for that reason, there is this idea and a big emphasis that it is still an idea by some of these banks that, well, instead of us taking the full kind of load and the full exposure, why don't we swap it for a margin loan based off of Tesla stock that Elon Musk owns. Now, this wouldn't be a hit to the Tesla balance sheet, but it would be Elon Musk taking it on in a personal capacity.
So, Kriti, how does this impact the wider S&P?
So we know as before Twitter went private, every time that Twitter shares went closer and closer to that $54.20 per share kind of deal price that Elon Musk kind of got near and then got away from, but eventually then took over at that price, Tesla shares dropped in return. The idea here was that Elon Musk, this visionary, wouldn't be able to handle both companies. The split attention would ultimately hurt Tesla, which is the 8th largest company in the S&P 500. By that same logic, if he was to undertake this risk, even if it is in a personal capacity, at the end of the day, Tesla shares are at risk, and that hurts the S&P 500 broadly.
I imagine shareholders aren't too happy about this.
They're not thrilled, but look, let's wait to see what happens in the pre-market here, because I think that's going to tell you everything. Once that U.S. trading opens, see just how negative they are on Tesla shares specifically.
All right, Kriti, thanks so much. Our Bloomberg, of course, reporter Kriti Gupta with the very latest on that pretty incredible story, our top read on the Bloomberg terminal. In the meantime, we got about half an hour ago a lot of, well, revenue from Trafigura. Trafigura Group earned a record $7 billion in its last financial year. This is more than the previous 4 years combined. So I don't know whether we have pre-market or whether we have something that we can show you in terms of Trafigura, but this comes as a commodity trader cashed in on wild price swings, but also arbitrage opportunities driven by Russia's invasion of Ukraine. I am reminded, and rightly so, that this, of course, is a big private company, the biggest in the world when it comes to a trader. It has an impact on listed companies such as Glencore and others, but this, of course, is privately owned. Volatility and disruption sparked by the war in Ukraine helped create the most profitable period in history for companies, as we know, that move energy energy, that move metals, and that move crops around the world. Rivals including Glencore, but also Vitol, have also reported some pretty blockbuster results. Now, let's check on the markets. I think we have a board to show you some of the asset classes and how they've been moving around, not only in the day, but in the last week. The picture for treasuries, let's look at the inverted yield curve. Our Valerie Teitel was bringing us that very story earlier on. We also asked Nouriel Roubini about the Treasury yield curve. So let's bring it up to see where we are. The big story, of course, what's been happening in the differential between the 10-year and the 2-year. Bloomberg is calling it the spread of dread. So if you look at the inversion in the 2 to 10-year, it reverted just a tad in Asia after reaching a 40-year peak of 85 bips overnight. Investors still remain wary about the signals emanating from bonds, of course, as well as other topsy-turvy portions of the debt curve, as history shows the herald recessions. So we look at this, we look at exactly what that means, but there's so many other signals and data, and also just listening to Fed officials, that it's maybe not as indicative as in the past. This also comes after 12 years of very cheap money, which is why some of this is distorted. A couple of other things we're watching out for today. Investors will get fresh clues as the ECB's thinking. We have appearances today by Christine Lagarde, but also François Villeroy de Gallo, the French central banker. Chips, this is a big one because Dutch officials are planning new controls on exports of chip-making equipment to China. This is according to Bloomberg sources. Negotiations are ongoing. An agreement of some sort may come as soon as next month. Now, the Dutch move, which could really essentially codify and potentially expand its unofficial ban on some tech sales to China, is, again, a step towards bulking up U.S. efforts to limit Beijing's chip-making and military ambitions. On the back of that, ASML down some 0.3%, but we're seeing a boost to Infineon and ST Micro. Coming up, it's a big UK show. That starts shortly. This is Bloomberg. Good morning, everyone, and welcome to Bloomberg UK, a new show with a special focus on the biggest challenges facing the British government, the economy, financial services and markets. I'm Francine Lacqua here in London. Now, on the show this week, strike action threatens to bring the UK to a grinding halt in the lead up to Christmas as a cost of living crisis begins to bite. We'll hear from the National Secretary of one of the UK's biggest unions. Plus, the government is also preparing to unveil its much anticipated reform package to boost the City of London. But will it be more of a whimper than a big bang? But first, where do all the challenges leave the Prime Minister, Rishi Sunak? He was meant to be a safe pair of hands after the turbulence of his predecessor, Liz Truss, but his hands now appear increasingly tied by backbenchers from his own party. So to get us started, Allegra Stratton, author of Bloomberg's daily UK newsletter, The Readout, former Downing Street press secretary, and she joins me now. Allegra, first of all,
Francine.
Massive shout out to The Readout. It's a great read. It's funny. It has it all. So if you don't read it, you have to go and check it out. It drops in your inbox at 5 p.m. every day. So where are we with the Prime Minister? He's, he was dealt a difficult hand, but now he's also not held by backbenchers.
No, I mean, it's the toughest inbox of any Prime Minister in recent times. He is dealing with a party that's been in power for 12 years now, an extraordinary period, but it does also come with, as you suggest, a number of different factions that have their views. I called it in the readout once the government of all the factions rather than the government of all the talents, because party management is the number one job at the moment. I think the main thing to say in his favour is that, if you remember back in September, the time of the mini-budget, the morning after the mini-budget, we had the pound falling very briefly, but to 103 against the dollar. People were predicting parity by the end of the year, weren't they? I mean, we wrote it in the Readout newsletter many times. It was different authorities saying at different points, this is going lower and lower and lower. And actually, we're now at 121 against the dollar, and people are saying, that we're sort of, actually, it is in better health than it's been for a while. I think we just should reflect that. But you are right that there are a number, the headwinds keep getting gustier and more difficult for him.
So, Allegra, how should the Prime Minister actually actually measure success? It's difficult. I mean, does he look at markets? And you're right, this...
I think he does, personally. We both know that he has a background in banking and in the city, so for him it is an indicator. And also, again, you know, was an indicator we were holding him to. So it isn't just him picking his measures. It was something that many people, investors, bankers, businesses around the country, around the world, needed to see from the UK. So I think that is a fair metric. But we also have to look at other metrics. You're right. We have Christmas and the prospect of crippling strikes. We also have inflation, which
terrible
has to...
inflation.
It is, as the Prime Minister himself keeps saying, it is incredibly gruelling for families up and down the country. But I think fundamentally what I feel this week and then in the last few weeks is that sense of that election coming into view, even though it is at least 2 years away. They have to do it by January 2025. Here we are coming up for Christmas 2022. So it feels to people watching perhaps like it's an exceedingly long time away. But actually some of the kind of groundwork, certainly by the Labour leader this week, we had a big speech from him. Some of that groundwork, you can see the parties positioning themselves for polling in a long time away, but you have to, that they have to sort of start to put their people in pole position.
So, Alara, do you think the Prime Minister is already in campaign mood, or at least it needs to try and be Prime Minister to all?
Yeah.
Right, if you look at that election in 2 years, and what does it mean in how the government deals with the strikes?
So in terms of, they will be starting to think about what are the critical, you know, sort of barnacles off the boat was a phrase that Linton Crosby, a Conservative strategist, used years ago, and it's still applicable. It is, what are the key things that when you go into an election you want to be able to demonstrate you have gripped and you have got some control over? You saw this week from the Labour leader him talking about handing power back to regions and to mayors and so on. At first glance, I mean, me and you have both covered politics for a very long time. You wouldn't have heard that kind of thing from an opposition leader. When I get in power, I'm going to hand it away. And he was challenged about this by journalists at his speech in Leeds. But the logic there is that, firstly, he thinks that people don't like the House of Lords being having lots of Conservatives sent to it, the Conservative Party officials from Number 10 in recent years. So he's trying to sort of point up a point of differentiation with the governing Conservatives in terms of propriety and so on. So you're already seeing those sort of fault lines trying to be laid. But equally, you could say of the Labour leader, is that a bread and butter issue? Is that something that families up and down the country will really be preoccupied? And I think that's the kind of thing we're going to see over the next year battled out.
But so, Allegra, I guess the devil's advocate would say, are they just letting the Prime Minister trying to deal with the cost of living crisis, inflation, you know, a torrid winter, cold snap where energy prices go up, and see where that lands, to see if that's their opportunity come up?
Look, I think you, as the opposition party, you can't see where anything lands. You have to grab the agenda and you have to shape it. And I think, you know, with the strikes for the Labour leader, he has to make sure he's positioned as, for some of his party, they want to see solidarity with the strikers. That's where the Labour movement has come from. On the other hand, Keir Starmer will be wanting to assess the public mood. At the moment, the public do seem to be very sympathetic to the strikers. I don't know how much that will change as Christmas gets more and more difficult to actually celebrate people struggling to get home to families around the country. So I don't know whether that will crumble. But more generally, when we look into 2023, a lot of people predicting not just that gas prices and energy prices this year are high, but they will be high next winter. And we have a subsidy package from the UK government right now. We don't know that there will be one next winter, but the families will be feeling the pinch just as much. So I think these are longer term problems that are going to cost money.
Allegra, you deeply care and have always cared. You were involved also in COP27 about the sustainability, climate change issues and green issues. Today we have the stamp of approval for a coal mine.
Yeah.
How does this country, how does the UK do when it comes to green issues and the race to net zero?
Look, I think the decision on Cumbria is disappointing. It has been a long time coming, as you say. It's a couple of years now in the offing. I would have liked to have seen the government do something more creative. There are a number of factories. So the chief thing in favour of the Cumbria coal mine is that it brings 500 jobs to a part of the country that does need a lift. but I would have liked to have seen a different kind of low carbon technology supported. There isn't any number, there's a huge offshore wind industry in that area. You could have given that kind of technology a boost in Whitehaven, where the coal mine's going to be situated. So I think it is disappointing, and I think there would have been alternatives if they had wanted to find a creative solution. But equally, I still think it is coking coal, so it's coal for steel. In terms of that headline offer, headline achievement, which is the United Kingdom coming off coal as a power source, we have seen some coal power stations have to be turned back on this winter, but still generally the direction of travel is in favour and away from it. So I think that it doesn't fundamentally change the UK's achievements in this area, but I think it's disappointing.
Allegra, thank you so much for joining us today. Allegra Stratton, they're author of Bloomberg's daily UK newsletter, The Readout. That's how I keep up to date, of course, on all things UK. We are also getting some breaking news on Unilever set to weigh actually a $3 billion sale of US ice cream brands. Unclear whether that means that Ben & Jerry's is also part of the portfolio that they're looking up for sale. We know Unilever has had extreme pressure from shareholders because they just have not delivered on a lot of their targets. Ben & Jerry's also always in the middle of a political turmoil, and that I don't know whether it is part of the decision to weigh the sale of the US ice cream brands. Coming up, as economists warn that the UK government is fighting a losing battle with unions over public sector pay rises, we'll speak to Andy Prendergast, National Secretary of Trade Union GMB. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Now, the run-up to Christmas in the UK is set to be disrupted by a wave of strikes across the rail network, the postal service, hospitals, and elsewhere. Workers in numerous industries in the public and private sectors are taking action over pay as prices continue to rise. Let's get more with our UK correspondent now, Lizzie Burden. So, Lizzie, are we headed in this kind of 1970s wage price spiral scenario?
Well, it does seem like history. It's the biggest wave of industrial action since Margaret Thatcher in 1989. As you say, we've got strikes every day from now till Christmas across sectors, people having to cancel their Christmas parties. But Callum Pickering at Berenberg had a great note yesterday. He said it's not like the 1970s for two reasons. First of all, the unions are weaker. In 50 years ago, there were half the population members of unions. Now it's a quarter. The government says it's going to get tougher on the disruption, and it's not a wage price spiral, it's a price wage spiral. And he says perhaps it's understandable that the unions are asking for pay rises when you've got double-digit inflation.
So what's the political impact for Rishi Sunak?
I mean, he's had a humiliating week on house building and onshore wind farms. So the longer this goes on, the more it erodes his authority. But it's also a difficult position for Labour. I was speaking to Pat McFadden, the Shadow Chief Secretary to the Treasury this morning. Labour today is pitching to be the party of business. I asked him, if that's the case, are you going to back Sunak getting tough on the strikers? And here's what he had to say.
When you've got such widespread industrial action, you need, to be honest, a better approach than going through one individual dispute after another and just condemning the staff that are taking the industrial action. All of this, I'm afraid, speaks to a government that's lost its grip.
So, Lizzie, can the government win the argument?
Well, its argument is it's pumped billions of pounds into supporting people with their energy bills. It's not going to give double-digit pay rises to public sector workers, which it says would add to inflation. Polling suggests that increasingly people see the unions in a negative light. A third of people want tougher restrictions. Perhaps that's because they're being directly disrupted. But when you speak to the unions, as I do, the answer is clear. The whole point of a strike is disruption.
Right, exactly. So we have Lizzie, thanks so much, Lizzie Burden there. Let's speak now to the National Secretary for the UK General Trade Union, GMB, Andy Prendergast. GMB General Trade Union in the UK, 460,000 members. Andy, first of all, you want maximum disruption to have negotiating leverage and negotiating power with the government. How will this end up?
Well, ultimately, I mean, we want maximum disruption, or we want the threat of maximum disruption. You know, unions don't exist to strike. We exist to get the best deal we can for our members. And in a situation when pay is falling behind the cost of living, you know, we ultimately have to take difficult decisions, and that includes strike action. When you look at the NHS strikes, the sad reality is we don't want to be here. Our members have had 10 years of effective pay cuts under austerity.
How exactly are the negotiations right now with the government? I mean, you're telling me you meet with them once a week, not more. Are you talking money?
Well, ultimately, we want to talk money. They don't want to talk money. But, you know, when you look at the NHS, we have 130,000 vacancies. It's about 10%. The service is ultimately not delivering what the public expect. And unless they deal with long-standing wage issues, this is going to carry on getting worse. So we're saying to the government they have to talk about money. At the moment, it's the elephant in the room they don't want to address.
Because they don't have the money?
Well, they choose not to have the money. You know, governments have a choice on where they get their money from, you know, and ultimately we've got lots and lots of tax breaks that are there. You've got non-dom status. You have the fact that taxes on dividends are far lower than wages. You know, ultimately, working people are watching the rich often avoid taxes, taking steps, and ultimately, we as a country have a choice. Do we want to fund our public services properly? Because at the moment, they're in free fall.
And who do you speak to on the government side? And actually, have you been able to give them assurances on some of the emergency services going through Christmas? Like, what is the chance of the strikes going ahead?
Well, unless the government come up with a better offer in terms of pay, they are going ahead. Now, my colleague is speaking to Steve Barclay, the Health Secretary. We're also talking to trusts on a weekly basis on how do we provide emergency support. But, you know, to emphasise this, we do not want to take strike action in the NHS. This is being forced on us by the failure of the government to address long-standing wage issues, and the situation is getting worse.
Do you need public support? So Lizzie Burden was bringing us the latest that, you know, public support is waning, or it's turning, because it's things that they deem, the public, that we deem as essential services.
Well, I've been stood on picket lines for the last 20 years, and what always amazes me is the amount of public support we get, and particularly in the NHS at the moment, we're seeing widespread public support. You know, our nation saw these workers get us through the pandemic, you know, putting themselves at risk. We all went and clapped for them every Thursday across the UK. Now they're saying they want decent wages, and we believe the public support is on our side. We know that they see how bad things are getting, that waiting lists are getting longer, that they're not getting treatment, and ultimately this is a cry for help in the health service.
Andy, what is the government saying in terms of working conditions? So is there any, you know, overture, or are they listening to demands on that side?
I mean, the problem with working conditions is that they're willing to have a conversation about it, but so much of it comes down to money. You know, ultimately, you know, how do you get better working conditions in the NHS? Well, you start by filling the 10% of vacancies we have across the service. If you can get those sorted, then there are other things we need to look at, you know, technology, rosters, all of these kind of things. But without that money underpinning it, then quite frankly, it's a waste of time conversation.
Do you think inflation, and we've seen, I mean, food price inflation getting some 20%, to energy 150% since the start of the year. There are also economists saying that then that slows down. Is that reflected in how much you demand wage increases by?
Well, at the moment, we have to deal with inflation being where it is. And we keep hearing about OBR predictions and economic predictions. But if I go back 2 years, none of them had inflation where it was at the moment. So, you know, economic forecasting is more a matter of guesstimates as opposed to an actual science. I think what our members are seeing is they're seeing high inflation with low pay rises. Now, we would rather be in a position of having high inflation and high pay rises. You know, there is an economic impact on that. But, you know, we seem to have a government who are very blasé about the rich's wages going off the scale. But whenever working people ask for increases, it's always an inflationary issue. I
mean, this government is different from the previous government, though. Is that fair? And do you think it'd be a different kind of conversation with Labour?
Well, we hope it would be. I mean, I think at the moment we as a union have to deal with the people in front of us, you know, through experience and having represented people in the public sector for over 20 years. You know, during the pre-2010, we had constructive conversations, and ultimately we saw things improve in the public sector. In the last 12 years, they've got worse and worse. But, you know, ultimately this isn't a political dispute other than the fact that the employer in this case happens to be the government. You know, for us, we want to make sure that whoever is in power, that our members are protected, that their standards are delivered and protected, and the public get the service they deserve.
Andy, thank you so much for joining us. Andy Prendergast, their National Secretary to the General Trade Union, GMB. Now, coming up, Big Bang 2, or more of a whimper. The Treasury is expected to announce reforms for the City of London this week, so we'll have plenty more on that next. And this is Bloomberg. Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Now, Bloomberg has learned that the UK government is also planning to announce a raft of measures aimed at boosting the financial services sector in the City of London. Now, the plan, which may be introduced before the end of the week, could include a sweeping away unnecessary regulations and securing opportunities from Brexit. Joining us now is our Bloomberg News City editor, Catherine Griffiths. Now, Catherine, we catch up every week, also because we do the podcast, and you absolutely own this story. The government, under Kwasi Kwarteng, the previous chancellor, wanted to do a Big Bang 2.0. This is like unleashing regulation and unlocking the City of London. And now it's not where we're getting.
No, we don't think, well, we actually think literally they're not going to use the phrase Big Bang 2.0. We've got the Chancellor, Jeremy Hunt, and Andrew Griffith, the City Minister, travelling to Edinburgh tomorrow. And we think that they're sort of repositioning what they're going to say. They're going to talk about the benefits of financial services to the whole country, and they're going to sort of underplay the notion that it's dramatic, it's big, it's a big bang.
So why is this? Are they, I mean, can they not unleash it, or are they worried about the backlash because we're in a huge cost of living crisis? We're just speaking to, you know, one of the main trade unionists as well.
Yes, I think it's both of those things. I think they've realised that it's really complicated and that actually there aren't a huge number of things that people in the city really want. That's partly because actually the UK played a really leading role in creating EU rules in the first place. So Andrew Griffith has gone around the city for the last few weeks, couple of months, talking to banks and insurers and asset managers saying, what's on your shopping list? We really want big, bold ideas. And he hasn't actually got a huge number back. So there's that issue. And then there is this real worry about backlash too. We've got a Prime Minister who's facing all sorts of opposition in various different areas. And there's a feeling that on this side of things, they've needed to rein in.
So is there regulation that actually the UK was forced because of Brexit that they could get rid of?
Yes, there are things they definitely want to change and that are directly related to being in the EU. There are parts of MiFID II which probably all of us, even here in finance a few years ago, might have felt slightly dead inside if we'd gone around the place talking about MiFID II. But there are technical changes to the way people invest and trade in London that they will change, and that will make some sense. But there are other things, like probably they'll talk about ring fencing tomorrow, which is the way capital is organised within banks. But actually that really has nothing to do with Brexit and the EU. That's just rules the UK brought in on its own and are going to be changed.
So, Catherine, what does the city want tomorrow? So, first of all, it's up in Edinburgh. They're calling it the Edinburgh Reform, so no longer Big Bang 2.0. What can we actually, I mean, how will the city interpret it?
So the city wants clarity and stability. There's lots and lots of people in the city who really don't want a great deal, but they would like, certainly inside the investment banks and trading institutions, they would like to see some more freedoms in where they can trade and how they can trade, and that will go down pretty well. But what they don't want is perhaps a watering down of other areas that have already been put in place, something like the consumer duty. They've spent lots and lots of money creating the right rules and regulations. They're not so keen actually to see those things being wiped away.
So what will the City of London become? I mean, I know there's also looking at the crypto landscape on whether they regulate it, and then at the time, maybe a year ago, there was also talk about some kind of ESG finance centre.
Yes, the city would love to become an ESG finance centre. It will create great opportunities for asset managers here in London. They would like to hear more about that, and they probably will hear more about that in the longer run, because certainly the Prime Minister is very keen on that. Crypto is a really divisive one. There are certainly people out there who want crypto reforms. They want London to get in on the kind of ground floor of the future that is crypto. But there's also lots and lots of people, whether they're MPs or they're consumer groups or indeed those in the financial services industry, who are quite sceptical about crypto.
Catherine, thank you so much, as always, for your contribution. Catherine Griffiths there, our Bloomberg City editor. Now, be sure to subscribe also to Bloomberg's In the City podcast that I host with David Merritt on Apple Podcasts, Spotify, and wherever you get your podcasts. New episodes drop every Thursday, so that's today. And, of course, Catherine is one of our regulars. We talk about not only, bonuses, but also, in general, what the new chancellor wants from the city. Up next, Bloomberg Surveillance Early Edition continues with Kailey Leinz in New York, Anna Edwards here in London, and this is Bloomberg.
A recession is not a question of if, it's a question of when.
I think the bigger risk heading into the first half is actually not being invested in equities. Not having exposure to stocks and sticking all your money in bonds and cash is a mistake at this point.
I think it is the absence of differentiation that most interests me, rather than projecting where everything is going at this juncture, which I plainly find very difficult to predict on any short-term time frame.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Xi Jinping in Saudi Arabia. He's attending a regional summit in a sign that the Gulf is now looking past the United States. Elon Musk's bankers consider a swap. They may give the billionaire new margin loans backed by Tesla stock to replace some of his risky Twitter debt. And a tough task for Peru's first female president. She'll try to restore confidence after her predecessor attempted to suspend Congress and call for a new constitution. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London, and Kailey Leinz with me in New York. Matt Miller is off today. And Kailey, there's a little bit more news around China reopening, or specifically Hong Kong actually reopening. We'll get to that shortly. But really it is concern around the global growth dynamic, concerns around recession that seem to be once again weighing on sentiment, certainly here in Europe.
Yeah, and you definitely see those growth concerns showing up in the bond market. But the equity market, at least in Asia overnight, was very much focused on that China reopening story and trying to cling to the good news. Of course, Anna, as you said, that reopening story today centered in Hong Kong after reports that the government is going to loosen restrictions surrounding test requirements for inbound travel, also possibly getting rid of that outdoor mask mandate. And that set Hong Kong stocks in particular ripping higher. The Hang Seng Index up about 3.4%. The Hang Seng Tech Index up by 6.6%. And of course, the optimism around the China story, in addition to the measures put in place by Beijing to help support the property sector, has given a really nice lift to iron ore, because the thinking is demand will be better. As a result, those futures up another 3% overnight at $109. That is the highest going back to August. And of course, we've seen some help for the Chinese currency as well. It is fractionally weakening against the U.S. dollar today, but still remains below that key 7 handle. Right now, the offshore yuan trading at 697 to the U.S. dollar. Now, speaking of U.S. assets, we have seen futures climbing throughout the session. They were lower earlier on, but now up about 0.1%. But remember, the S&P 500 is coming off of a 5-day losing streak. So we will see if we can turn it around today, as equity investors really are focusing on the growth outlook. And that brings me to the bond market, which I mentioned. The 10-year yield today up about 3 basis points, right now sitting at 3.44%. That leaves the 10-year yield about 83 basis points below the 2-year yield. This is a very deeply inverted Treasury curve. Yesterday, it was about 84 basis points negative. That was the most inverted the curve has been, going all the way back to 1981. So really signaling concern about growth out there. And of course, growth concerns have been weighing on oil. A little bit of a bounce back for WTI this morning, up about 1%, but still at 72.70. We remain near the lowest levels of the year, Anna.
Yeah, and that inverted yield curve certainly getting a lot of conversation, a lot of talk over the last 48 hours then, Kailey. Let's have a look at where this is playing out for European stocks. You've been through what happened there in Asia, what the expectation is in futures, and Kailey pointing to little movement in futures. And we've got little movement, really, overall on European stocks here. We have the FTSE 100 down 0.1%, but gains over in France up 0.2%, the DAX fairly flat. So a mixed picture really coming through for European stocks. Let's roll on and show you some of the specifics that are driving the session. Kailey talked about WTI. We have Brent at 77.74, up by 0.7%. So still quite relative to recent history, relative to the 120s, 130s that we saw earlier on this year. These are more modest levels, but given what we've heard out of China, many people are a little surprised we haven't seen more upside to the oil price. It's up today, but that after some challenging trading in recent days, despite those China reopening lines. So 77.75 on Brent. This is where we are on the energy names today. So energy stocks are trading higher, up by 0.8%, taking their cue really from what we have here. And it's not an enormous move, not a particularly exciting move, but we don't have much on the move in terms of stocks today. So I put that one in there just to reflect the best performing sector here in Europe, and that is around energy stocks. This is an interesting story. ASML is the maker of lithography machines. So there's big pieces of equipment that make that are provided to chip makers so that they can make chips. And the United States is looking for friends when it comes to reducing the ability of China to import some of that important equipment. And ASML is one of the Dutch businesses that are currently being being talked about because the Dutch are considering joining the US in making it more difficult for China to get hold of some of that equipment. ASM International, also in focus on that front. On the Beach Group is a really small business in the UK, but it was interesting the way, Kailey, they were talking about how the consumer is performing, the cost of living squeeze, the higher energy costs, all of that very front and centre for UK consumers. And what they're saying is that they've actually seen some decent demand for their long haul and their more expensive travel, but it's at the lower end of things, the sort of 3-star hotel bracket, where they are seeing the pain fall on consumers.
Yeah, maybe people spending a little bit less on vacation and leisure travel during a difficult cost of living time. So definitely a story we'll continue to keep an eye on. Another story we are watching today, Chinese and Saudi companies have agreed investment pacts and signed them for green hydrogen and solar energy during a visit of Chinese President Xi Jinping to the kingdom. The trip marks the region's deep and growing ties with Beijing as U.S. relations come under pressure. Bloomberg Saudi Arabia Bureau Chief Matthew Martin is joining us now. So Matthew, what did the Saudis want to get out of this trip?
Well, I think, as you mentioned there, there's already been around 40 agreements that have been signed. Some of this is pushing into new energy areas like renewables and hydrogen power, which is where the Saudis want to move away from just exporting crude oil into going into being a broader energy producer. And so they want, they're looking around the world and looking to shore up these relationships so that they have places where they can send the hydrogen that they produce, so that they can invest more in renewables. But also, of course, you know, China is Saudi Arabia's biggest oil customer, so they need to shore up that relationship. They need to get that understanding of the Chinese economy and invest in the Chinese economy and in refineries there so that they can continue to build on that. The other thing as well that the Saudis want is they want to position themselves as a regional leader, a regional convener. So that's why we're going to see tomorrow a big summit of Gulf and regional leaders all coming here into Riyadh under the hospitality of the Crown Prince Mohammed bin Salman to meet with China and take a bigger regional view on trying to deepen those trade and investment links with China.
And the United States, of course, has a complex relationship with Saudi Arabia, an increasingly complex relationship with China as well. So how is the US viewing this visit?
Well, exactly. As you say, the Saudi-US relationship is at probably one of its lowest points in decades. The US has said that they don't want to lose this region to the sphere of influence of countries like Russia and China. But at the same time, they've also said that the deepening trade and investment ties, particularly around areas like defense and technology, will put a ceiling on US involvement in the region. So they'll be watching closely to see what comes out of this, particularly on the defense side. The US has traditionally been the protector and the guarantor of Saudi security. So they will be watching to see what comes out of this visit in terms of deepening those ties and what it means for the US investments here, because they don't want to see this sort of commingling of US technology and Chinese technology, and they are very much leaning on the Saudis to try and isolate China. But the Saudis are saying that you know, they think that they can play both sides at the same time, that they can have US technology and that they can have Chinese technology. And so we'll probably see over the next 24 hours how the US reacts to what comes out of this visit by President Xi.
A complex tightrope to walk, one that will be familiar to many governments around the world, I'm sure. Thanks very much to our Bloomberg Saudi Arabia Bureau Chief, Matthew Martin, joining us there from Riyadh. Over to Hong Kong now. The city is taking another cautious step towards a full reopening. The isolation period for people who test positive for COVID and their close contacts has been shortened, and inbound travellers will be required to take fewer rapid tests under the new rules and regulations. Bloomberg's Tom McKenzie joins us now with more. Tom, so take us through what's changed in Hong Kong.
Yeah, and Anna, the context is that Hong Kong moved earlier than the mainland in terms of easing some of the restrictions. And then, as you say, in the last 24 hours, 48 hours, we've had additional moves, gradual moves, but consequential in terms of making it easier for people to travel into that city. They're having to quarantine for a short amount of time. And those who are infected as well, having their quarantine period shortened. They're going to introduce those rapid antigen tests that we've all become very familiar with, having to put less on the PCR tests that, of course, were essential in terms of how China and how Hong Kong were tackling the spread of COVID. For the markets, of course, you saw a very strong rally, particularly on the HS Tech Index that Kailey was touching on, but also Macau gambling stocks. And for me, that points to what really investors are focused on, which is the opening of the border between Hong Kong and Shenzhen. Not happening yet. It's less about the mask mandate that remains in Hong Kong. It's much more about when you reopen that border, speculation, placing your investment bets on that happening at some point in the near future, because that is going to be a considerable input in terms of shoring up the beleaguered Hong Kong economy, having those tourist flows come in from the mainland to Hong Kong to shop and spend their money in that city.
Well, let's talk further about the mainland then, Tom. How are the newly relaxed measures playing out there? I've seen some pretty dire predictions about what ultimately could happen to COVID cases.
Well, indeed, health officials in China, in Beijing, coming out and saying that ultimately the majority of the Chinese population could end up being infected with COVID. And of course, it's consequential given that the vaccination rates, as we discussed previously, particularly for the most vulnerable age groups, the plus 80s, are relatively low, particularly in comparison to countries like the US, the UK and other European nations as well, about 65% for the plus 80s. Now, the officials say they're going to try and ramp up that vaccination program. So how important or how much success they have there is going to be consequential. And then, of course, you're seeing them put in place measures to build out what they call as fever clinics and putting more money into the healthcare system. They could have done that 3 years ago, so it's a bit of catch-up that's playing out there as they brace for rapid increase in infections. The official numbers suggest that infections have come off, but actually that's, of course, because the testing sites have been wrapped up in many cities like Guangzhou, but also Beijing as well. They're still testing, but not as much as they were before. So yes, they're braced for an impact, or at least a big uptick in terms of COVID infections. And that, again, just reminds us that they may have had this pivot, but getting away and walking out of COVID zero is going to be very complex and painful.
Yeah, could be a bumpy ride. Tom, thanks very much. A complex picture. Tom setting it out very clearly. Tom McKenzie there with the latest on Hong Kong today, but the broader China story as well. Now, Bloomberg has learned that banks which backed Elon Musk's Twitter takeover are considering providing him with new margin loans backed now by Tesla stock. Bloomberg Markets correspondent Kriti Gupta joins us now with the details. Kriti, take us through this and how this would work.
Well, look, this is a $44 billion acquisition. $13 billion of that 44 was financed by Twitter debt originally, but then taken over by investments from private equity and other kind of equity type of commitments. But that Twitter debt, which was largely financed by like some Morgan Stanley, SocGen, among many others, well, they're doing it at extremely high interest rates, 11.25%. And for context here, the average issuance right now in the U.S. investment grade bond market is about 5%. So there is a risk premium really baked into this Twitter debt that a lot of these banks can't actually unload or even get institutional investors to hop on board for. And that's a real problem because now some of these banks are personally taking on that exposure. And that's what they're trying to avoid here. They're trying to swap them out essentially for margin loans that are then not backed by Tesla shares specifically, but by Elon Musk's exposure and own equity in those Tesla shares. So it might make Tesla investors a little bit nervous here, but at the end of the day, this is a thought that would happen on a personal level.
Well, you say Tesla investors might get nervous, but I would argue that maybe the broader market has reason to be nervous as well, considering Tesla is such a heavyweight in the U.S. equity market.
Well, we saw this dynamic before, Kailey, when the saga was kind of continuing, this idea of the inverse correlation between Twitter shares and Tesla shares, the idea that as Twitter got closer and closer to that $54.20 deal price, Tesla shares were then dropping in reverse and vice versa. The idea here that being that Elon Musk's split attention would ultimately hurt the bottom line of Tesla, just given the vision that he has had has driven the company to become the 8th largest in the S&P 500. So if you start to see those jitters show up in the pre-market this morning, and arguably when those shares actually open for regular trading at 9:30 New York time, that's going to be a key indicator that actually the entire benchmark, even if you're not invested actively in the Twitter story, you are exposed to the Twitter story via the benchmark.
All right, Bloomberg's Kriti Gupta, thank you so much. And while we're talking about individual stocks and their influence on the market, let's take a look at some stocks moving in pre-market trading in the U.S. this morning, Tesla aside. One of the big outperformers is Rent the Runway. This stock is up 18% after it reported results, beat and raised quarter. Not only did it top estimates when it came to third quarter revenue, the guidance for the annual print also came in ahead of expectations, and subscribers were up about 15% year on year. So analysts really happy with the quarter. Investors clearly are as well. well. And other stocks moving to the upside, and Tom McKenzie alluded to this when we were having that conversation about Hong Kong, but those that are dependent on gambling revenue from Macau, including U.S. casino operators. Wynn Resorts, Las Vegas Sands, they each get more than half of their revenue from that Chinese gambling enclave. So as a result, they're getting a nice lift in pre-market trading. Las Vegas Sands up about 5%, Wynn Resorts up about 4%. And one final stock that we have to check on as well, is Bilibili, and this comes back to the China story. This stock is up 143% since the beginning of November. Absolutely remarkable. And today, on the back of that better news around the reopening and the easing of restrictions in Hong Kong, it is adding to those gains, up another 11% before the bell, Anna.
Okay, big moves there for that Hong Kong business. Now, coming up on the programme, Kailey, we'll get back to the macro story. Laurie Heinel will join us, Chief Investment Officer at State Street Global. We hear a lot of conflicting views on whether the Fed is on the brink of over-tightening. We will get Laurie's view, State Street's view, shortly. And the Coinbase CEO believes crypto legislation may pass within the next year. Part of our interview with Brian Armstrong ahead.
There's strong bipartisan support in the U.S. to actually get clear crypto regulation. The FTX situation created a little bit of a delay in the legislation that I was hoping was going to be getting passed in the next quarter or so. But I think within the next year, we can hopefully get something there.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz in New York with Anna Edwards in London. Matt Miller is off today. Well, Anna, let's talk about today's big take story because it takes a close look at Ghana as a case study for the challenges facing emerging markets that borrowed heavily when the cost to do so was cheap and now have seen their fates change. Ghana's currency is on track to become this year's worst performing, with the government priced out of the overseas bond market and forced to seek an IMF bailout. Ghana is one of at least 15 of the 72 emerging markets in a Bloomberg index that now have dollar debt trading at distressed levels. I have a chart here looking at the options adjusted spread to the U.S. Treasury curve. If you want to see the chart, you can find it in today's big take story on the terminal and online. But we see Ghana trading at 3,141 basis points. So joining us now is Donna El-Baltaji, Bloomberg managing editor for credit. Do we have a proper understanding of the default risk facing emerging markets right now?
I think that we do. I think what we're facing is actually quite worrying, because not just because of how much they borrowed over the past few years, but also because markets are closed. So in order to refinance the debt that's coming due, a lot of these sovereigns are going to face a lot of issues.
And Dana, this is an age-old dollar FX risk story, isn't it? A lot of these countries have got themselves into this predicament because they loaded up on dollar debt. The dollar has changed in value substantially from the time that they did that, and now they find those debts unaffordable. This is, and it's much wider than just Ghana, as Kailey was alluding to.
Absolutely. This is emerging markets' original sin. Basically, you go to a market and you load up on debt in a currency that isn't yours, and then all of a sudden things shift. And the issue here is that when things shifted, the entire world saw borrowing costs go up. So there is no place of refuge. So now they're stuck with massive, massive loads of debt, a dollar that's super strong, the inability to meet those debts, really, and the inability to find new financing. And that's why a lot of people are raising the alarm, saying that emerging markets need help, and we need to figure out how to finance those debts.
We thought the emerging market that may need help, or that a credit event might emanate from, was China for a long time. It seems that now is a narrative that has shifted as they've taken a number of measures to prop up the property sector, for example. So do we no longer need to worry about China?
I think we always need to worry about China because it's such a massive economy, and anything that happens in China impacts the entire world, not just emerging markets. And I think actually that is the massive elephant in the room for the entire world economy. If China does not open up, that's going to impact oil prices, and that will also impact emerging markets too. If it stays closed, of course, we will still see issues with inflation and all of those knock-on effects that we've been experiencing over the last 2 years. So yes, even though China is taking some steps in order to alleviate the pain for some of the companies there, it's still a massive issue that we all have to watch out for.
Okay, Dana, thank you very much for that update. Bloomberg's Dana Al-Battaji joining us with the latest on emerging markets. A great big take story. NI Big Take is the function to use if you want to see that on the Bloomberg terminal, also available on the Bloomberg website. And for more market analysis, check out MLI Vigo. That is the function to use for the Markets Live blog. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Anna Edwards in London. Matt Miller is off today. Now, keeping you up to date with news from around the world, here's the first word. Vladimir Putin acknowledges that the war in Ukraine is taking longer than expected. But the Russian leader says that what Moscow calls the special military operation has succeeded in seizing new territory. Putin also said that Russia's nuclear arsenal is deterring escalation of the conflict. Bloomberg has learned that the Netherlands is planning new controls on exports of chip-making equipment to China. That could align Dutch trade rules with U.S. efforts to restrict Beijing's access to high-end technology. Washington has been pushing its allies to join efforts to cut off China. And in Peru, the country's sixth president in 4 years begins her first day in office, trying to build a cabinet and restore confidence in the economy. Dina Boluarte took over Wednesday after President Pedro Castillo tried to suspend Congress and call for a new constitution. Castillo's moves were described as an attempted coup. Congress voted to impeach him, and he's now been detained. So, Anna, this was quite the breaking story out of Latin America yesterday. A lot of volatility in the Peru political system at the moment.
Yeah, absolutely. And not even just at the moment, Kailey. Looking at some of our reporting, tells me that every elected president since 1985 in Peru has either been impeached, imprisoned or sought under criminal investigation. So certainly only the brave, perhaps, heading for that top office. Now, coming up on the programme, we will talk markets once again. Laurie Heinel joins us, Chief Investment Officer at State Street Global. We'll get into a conversation about whether the Fed is on the brink of over-tightening. That certainly is the suggestion coming through from their research. I spoke to a guest earlier on who said he could not disagree more with that kind of sentiment. So we'll get to the varying views about how high the Fed goes from here. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Xi Jinping in Saudi Arabia. He's attending a regional summit in a sign that the Gulf is now looking past the United States. Elon Musk's bankers consider a swap. They may give the billionaire new margin loans backed by Tesla stock to replace some of his risky Twitter debt. And Hong Kong's looking at a major relaxation of its tough COVID restrictions. The city's isolation period has been shortened and testing for travellers will be eased. I'm Anna Edwards in London with Kailey Leinz in New York. Matt Miller is off today. And Kailey, it seems that global equity markets, risk assets, then even really searching around for direction in today's trade.
Yeah, especially after 5 days of losses straight on the S&P 500. Will we see some relief coming in today? Right now, looking at the futures session, honestly, it's not all that convincing. Yes, we are in positive territory. Futures are up by about 0.1%, but they were lower earlier, so not a lot of conviction in buying, it seems, coming in today. Right now, S&P E-minis trading at the 39.41 level. In the bond market, this is really where you may see some of the concern that's weighing on risk sentiment reflected. The 10-year yield is up about 3 basis points. 344 is where we trade, and that leaves the 2-10 spread, that yield curve that we all watch for recession risk, inverted by about 83 basis points. Yesterday, of course, inverted by 84 basis points, which was the most steeply inverted that curve has been, going all the way back to 1981. So it really reflects the concern that investors seem to have about the Fed tightening and choking off growth in the process. And of course, those growth concerns, not just in the U.S., but globally, have been weighing on the oil market. WTI crude getting some relief today, up about 0.75%, but still trading down at $72.55 a barrel. Now, as for some individual stocks to keep an eye on in pre-market trading here in the U.S., Anna, you mentioned the Tesla story, the possibility of new margin loans backed by Tesla stock in order to get rid of some of that high interest debt that he had to pile on to take over Twitter for $44 billion. Interestingly, not weighing at all really on Tesla stock this morning. It is actually up about 0.6%, but that is part of a move higher broadly for large cap technology stocks, including Apple, up about 0.3%. And of course, it's not just about US tech, it's about Chinese tech as well. We saw huge gains in Asia on the back of those more perhaps optimistic headlines out of Hong Kong and the easing of some restrictions there. So as a result, the ADRs of Alibaba, JD.com, each up in the ballpark of 3 to 3.5%. Anna.
Interesting to see that China news flow then having an impact on what you're seeing there in the United States pre-market, at least in those China-exposed stocks. Not part of the bigger narrative here in Europe, although I will say we seem to be off earlier lows just a little bit, down 0.2%, though, still on the stocks Europe 600. We've got Brent crude rising, and so energy stocks are that's one sector where we are seeing some upside, the best performing sector for much of this morning's session here in Europe. Brent crude at 77.53. That is a move higher, despite the fact that the handle is down at 77. I say down because, of course, we've been as high as the 130s, the 120s earlier on in the year. ASML, this is a technology business based in the Netherlands. They make the giant pieces of equipment, that the lithography machines that are then sold to chip makers around the world to make chips. And it seems the United States is reaching out to the Dutch government and trying to bring them on board in its attempts to limit China's access to some of this chip-making technology. And so with that in the news flow, that is weighing on ASML. It could also weigh on others who supply the chip sector. And On the Beach Group is a fairly small business here in the UK, but it provides vacations, packaged holidays. And it was interesting how they were segmenting the UK consumer right now, suggesting that those who are buying long-haul and more expensive trips continue to do so, but the cost of living squeeze really having an impact on those who are seeking out maybe the lower price brackets of holidays. So that's an interesting dynamic to watch around the UK consumer. Let's broaden our conversation, talk big picture markets. Laurie Heinel joins us, State Street Global Chief Investment Officer. Laurie, thank you so much for being with us today. And I want to start with somewhere we don't see much conviction, it seems, in stocks, certainly in today's session. We have seen some interesting moves when it comes to bond markets, though, and treasuries. The long end of the treasury curve increasingly seems to be focused on recession risks. How concerned are you about recessions, and do you see that as the dynamic that is affecting bond markets?
Well, we're quite concerned, and not because we think it's inevitable, but the longer that the Fed continues to have to tighten policy and the longer that inflation prints remain high and things like job markets remain strong, at least on the surface, the risks of that recession are real, and we're seeing that reflected in long bonds.
So if we're talking about that real risk of a recession, Laurie, how do you position? How do you protect yourself?
Well, right now, we believe cash is king. We actually have quite a large overweight to cash in our balanced portfolios, and the vast majority of that allocation has been coming from bonds, where we've been quite cautious on credit, for example. But we also do think that there are still ways that we can get out of this, and we want to keep a little bit of that dry powder. So if we start to see a little bit of signs that perhaps we're not going to have a deep contracted recession, then that would be the impetus for us to go ahead and deploy some of that capital.
When do you expect to see those signs, Laurie, and in what actual form will those signs materialize?
Well, we're hoping to see something in the first quarter. I mean, certainly the Fed has signaled that they're willing to take their foot off the gas a bit if they can start to see signs that they're finally getting inflation under control. And we may have seen peak inflation at this stage in time. We're seeing that tail off just a little bit. So you do have this window, if you will, that we start to get kind of past the holiday season. You start to see some of the data soften, and suddenly the Fed does not feel quite so pressured to respond to the immediate prints that they're seeing, and they can let the work that they've already done take hold.
Laurie, it's interesting. That's your view that we're on the brink then of over-tightening, or the Fed is on the brink of that over-tightening. I put that view to one of my guests earlier from BNY Mellon, who said that they couldn't disagree more with it, in the sense that with inflation as high as it is, with central banks having a very clear mandate to bring that inflation down, they just didn't see, they thought that it was basically premature to have a conversation about over-tightening. Do you get any pushback on that from clients?
Well, it really depends on what you're talking about. If what I'm taking away from that comment is that they think that inflationary pressures may stay elevated for a while, which would basically force the Fed's hand to continue to tighten. And that's exactly the dynamic that we're talking about, because under that scenario, then you do choke off what little bit of growth we do see, and you potentially put yourself in a really tough situation towards the back end of the year.
So do you think that inflation does stay elevated, Laurie, or you think it comes down?
Yeah. Well, it depends. Our core call is no. Our core call is that we're already seeing signs that inflation is starting to top off. We're already seeing signs that the Fed's work has started to take hold. Plus, a lot of the massive stimulus that we had during the post-COVID era is starting to wear thin as well, as we're starting to see things like savings rate deteriorate quite dramatically. So we think there's still a window, and our core call is that we're actually going to navigate a bumpy but somewhat soft landing. The problem is that there are just a lot of risks to the downside right here.
Well, Lori, obviously you're global CIO, so we can talk all we want about the U.S., but the picture can look very different in other parts of the world. How are you looking at Europe, for example, or the emerging markets? We were just having a discussion about the risks that some emerging markets that borrowed heavily when borrowing costs were low are now facing in an area where they can't really borrow in the same way. Those markets are closed. There may be default risk on the horizon.
No question. And we've actually been quite constructive on Europe all year, perhaps shockingly so, given the events that have unfolded there. But we think we've actually been vindicated a bit as we look at the markets over the last several months. And one of the reasons that we were more positive on Europe was that we actually thought that the energy crisis would be managed, and they've kind of gotten that under control, at least for this winter. But we also felt that the valuations were just so beaten down that there was good value in European stocks. So across the equity complex, we're underweight US, but we actually have been overweight Europe, and we continue to be overweight there. Emerging markets is just a really tough one. It's so dominated by China, and we do think that you could see a bit of a relief rally here as China starts to open from its zero COVID tolerance policies. But we just don't think that's sustainable, because those are places where the strong dollar has continued to be a headwind, concerns about COVID continues to be a headwind, and you have winners and losers in the energy complex.
Okay, so Lori, you talk about whether the China rally is sustainable. We have seen remarkable moves after the last month and change. The rally we saw in November, it frankly has continued, definitely today. You think all of that is overdone? You wouldn't be a buyer of Chinese assets here?
Well, certainly we think they have a lot of challenges in the long term. So buy the rally if you can, but we've remained underweight because we don't think that that's necessarily sustainable. And we've seen the story before where it looks like policymaking is favoring reopening, and then all of a sudden something happens which leads them to reconsider that reopening trade. So we think it's a bit early to call the all clear on emerging markets.
Lori, when you think about where the dollar goes and whether we have seen peak dollar, do you think about the return to geopolitical risk? There's no clear off-ramp, perhaps, in what's happening between Russia and Ukraine at the moment, Russia's war in Ukraine, and, of course, tensions between the US and China build. Where does that leave the dollar?
Well, that's the biggest wild card in terms of dollar directionality from here. The dollar is already quite overvalued. And if you start to see some normalization on rates around the world and some normalization on growth around the world, there's no reason to think that the dollar sustains these kind of lofty levels. But as you say, it is still one of the few safe havens against geopolitical tensions. And to the degree that those things stay front and center for investors, there will be a strong dollar bid.
Lori, thanks so much for your time. We do appreciate you getting up so early for us. Lori Heinel joining us there from State Street. Coming up on the programme, the Coinbase CEO is optimistic about crypto regulation in the next year. Part of our interview with Brian Armstrong next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, an interview with the Greek finance minister. That's at 8:30 a.m. in New York, 1:30 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Anna Edwards in London. Matt Miller is off today. Well, Anna, the Coinbase CEO Brian Armstrong sees revenue cut by at least half this year as declining prices and the collapse of rival FTX rattle investor confidence. Speaking to Carlyle Group's David Rubenstein, Armstrong also said Coinbase is working with policymakers on improving regulation.
I do think the FTX downfall is a bit of a black mark for the industry, and it's not representative of the whole industry, of course, though. And, you know, in traditional financial services, occasionally you see bad actors as well, like Bernie Madoff or what happened at Enron. Now, in terms of regulation, you know, I do think that it won't be a bad thing. We've actually, Coinbase has been calling for clear regulation and trying to work with policymakers for quite a while. We've made some progress on that across various G20 countries. But I think it will serve as a wake-up call and sort of a moment of catalyst where we'll get more clear regulation in the United States. And I think that'll actually be a good thing for both Coinbase and the whole industry.
Sam Bankman-Fried was supposedly interested in having the CFTC, which regulates commodities, be the regulator for the industry rather than the SEC, which tends to regulate securities. Do you have a view on which is better for the industry and what you would prefer as the regulator?
Yeah, so crypto is actually many different things. So there are some crypto commodities that should be regulated by the CFTC. And in the future, they may even want to regulate spot trading of commodities, which doesn't happen in other commodities for crypto. Then the SEC should be regulating crypto securities. And I actually think that could be a very important and big business in terms of how people raise capital for their businesses and investments, things like that in the United States and elsewhere. And then crypto is also many other things. You know, it has stable coins, which are more like currencies. It has artwork like NFTs. And in the future, it's going to have even other things, you know, decentralized identity systems and new ways to build applications. So unfortunately, it's kind of like when the internet first came out, people had wanted to think of it as one type of thing, but it turned out to empower many different types of use cases. And so there'll be different regulators for different aspects of the crypto economy.
So for your company, people who are clients of Coinbase, you reassure them, I assume, regularly, or they can find out for sure if their account is managed the way it's supposed to, it's not being used for some additional purpose. Is that right?
That's right. So, I mean, we actually are very different than what happened with FTX. So for one thing, Coinbase is based right here in the United States. We didn't incorporate in an offshore jurisdiction like the Bahamas. We're also a public company, which means we need to meet all of the audit requirements of a public company. And so we show in our publicly audited financial statements that, you know, corporate cash is separate from customer funds, and you don't have to take our word for it. A Big Four accounting firm has come in and proven that in these cases. So there's other differences as well. You know, we operate an exchange, but we've never created an exchange token like the way FTX did. We never operated our own market maker or hedge fund in the way that FTX did, because we believed that would be a conflict of interest. So the difference between the two firms, I think, cannot be overstated. And it's really a validation of the approach that we've taken at Coinbase over the last 10 years to sort of build this business in a trusted and compliant way, as opposed to what happened with FTX.
So how do you respond to the idea that many people don't know what they're doing when they're buying cryptocurrencies? They're not that well informed, they're very young, and they're going to wind up losing their money because they're just not experienced. How do you respond to that concern?
Right. Well, I think that's a very valid concern across really any type of investment that people might make, not just in crypto, but in stocks and in everything. There's a lot of legislation being put through Congress now, and Coinbase has been very active in DC, working with policymakers there. There's strong bipartisan support in the US to actually get clear crypto regulation. The FTX situation created a little bit of a delay in the legislation that I was hoping was going to be getting passed in the next quarter or so. But I think within the next year, we can hopefully get something there in the US and then go for the rest of the G20 as well.
That's Brian Armstrong from Coinbase. To watch more of that interview with the Coinbase CEO, tune in to Bloomberg for the David Rubenstein Show's peer-to-peer conversations. That full program, January the 11th at 9 p.m. in New York. Let's stay with the crypto story. Several U.S. senators are willing to subpoena FTX founder Sam Bankman-Fried if he doesn't choose to voluntarily answer questions. Senators Sherrod Brown and Pat Toomey have asked Bankman-Fried to testify before a hearing on FTX's collapse next week. Joining us now is Anna Herrera, Bloomberg senior crypto editor. Anna, is that when we get more facts, or are there just not more facts to ascertain when it comes to FTX? I mean, there's still a sense that he needs to answer more questions, I suppose, but we have heard a lot.
Yeah, he has been speaking a lot, but people are still wondering what happened to the $8 billion that no one seems to figure out where they've gone. So there are definitely still facts that need to emerge. And as you said, sir, U.S. senators are hoping that he'll turn up to this hearing next week and sort of answer some of those questions.
Yeah, and it's not just a Senate hearing, it's a House hearing as well. And Maxine Waters, the congresswoman who leads that committee, also said a subpoena is not out of the question for her committee either. Anna, the other Anna, was just mentioning that full Brian Armstrong conversation on peer-to-peer is going to air on January 11th, which is more than a month away. And it strikes me that who knows what could happen in the next month in the crypto sphere. FTX aside, and figuring out what happened there, are we positive that all of the ripple effects, all of the contagion has already been seen, or could more dominoes fall?
No, I think we have to wait to see if more dominoes fall. If you think about it, the FTX, in a sense, was perhaps part of what was happening before that started in May and started with Terra. So, that was a very long contagion in itself. So, we might see more happening into the new year or, into the second quarter. We really have no idea yet.
Are there any specific players that your team is watching that seem highly vulnerable to that?
We've mentioned Genesis before. We've been reporting that they've been trying to raise funds to avoid bankruptcy. So that's one we're trying to watch. And obviously, anyone who turns up to be a creditor of FTX, there are very big creditors in a creditor list that remains redacted, so we don't know. But there are claims for 200 million, 50 million, big ones. And you wonder, does that mean the end of the line for these firms?
So if a judge would decide to unredact that list, then that would lead to a lot more information about where the risk lies. Let me ask you, going back to that interview that we played with the Coinbase boss there, it taps in nicely with the Bloomberg Business Week story that just dropped in the last few minutes, in the last 45 minutes, talking about a handful of simple rules that might have prevented FTX's demise if only they had been applied. But this goes back to what we were hearing there from Coinbase about how, because there's so much discussion about what type of assets various crypto assets are, and he was saying some are like commodities, some are like currencies, some are like securities. Things seem to fall between the cracks, and then nobody ends up regulating them. So, for example, we wouldn't have the commingling of funds, of client funds, with the funds belonging to the hedge fund if the SEC had been regulating. And this seems to be where a lot of the conversation is heading.
So, the SEC, the chairman at least would argue that the rules are in place, and he had been calling for exchanges to register. The problem was FTX wasn't really, aside from FTX US, the main exchange was outside, was offshore. So, the industry has been claiming has been saying the rules aren't clear, and regulators, in a sense, have been saying, well, they are, you just need to register. So it's kind of a situation where obviously clear rules might help, but following the existing ones might have also helped prevent a disaster.
Well, and of course, FTX was operating in the Bahamas, so there is this jurisdictional geographic location question. And while we talk about a lack of regulatory clarity in the U.S., arguably there is a little bit more in areas like Europe, in which you are located, Anna. Have we sensed that those regulations, that the MiCA protocol that Europe already had just agreed to a very short time ago, is going to change in the wake of this?
I don't think there's any sense of that. It still needs to be officially approved, but obviously people in the sector are saying it's a great step forward and are saying, if only, the US were like Europe, we'd have more clarity. But again, you can have rules. What's important is, that they get followed and they get enforced.
Right. And rules can still be broken, even if they do exist, if someone is a bad actor. So that's all things we have to consider. Bloomberg's Anna Herrera, thank you so much, as always, for your great reporting on this continued saga. And of course, this saga one we continue to discuss each and every week on Bloomberg Crypto. So make sure to tune in every Tuesday at 1 p.m. New York time, 6 p.m. in London. It's Matt and I's weekly show covering the people, transactions, and technology shaping the world of decentralized finance. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Anna Edwards in London. Matt Miller is off today. And let's take a look at what he's missing in the day ahead. What's coming up on this Thursday at 7 a.m. Eastern Time, we'll hear from ECB President Christine Lagarde at the 6th Annual Conference of the European Systemic Risk Board. It's the last day before the ECB goes into its quiet period. Of course, the Fed in one already ahead of its decision next week, which could be informed by the economic data here in the U.S. Initial jobless claims at 8:30 a.m. Eastern Time. Then at 1:30 p.m., the federal court hearing on Meta's acquisition of virtual reality app Within Unlimited will begin. And then later on today, we'll have some earnings. Results from U.S. retail giant Costco and U.S. chipmaker Broadcom will be crossing. And Anna, I'll be really interested within those conference calls and perhaps the statements for those companies as well, what their commentary is around the growth outlook and recession risk, because that is something we seem to be hearing about each and every day and is clearly reflected in the Treasury market.
Yeah, absolutely. The Treasury market really responding to that. Certainly the long end factoring in those growth concerns. It'll be interesting to see what we hear from them on that front, the global growth story, but also around the geopolitics when it comes to anything to do with the chip sector, Kailey. That's going to be really interesting. So the interesting news flow in Europe this week, tapping into the US news flow around chips, suggesting that Washington is looking for the support of European governments in trying to isolate China further in its access to chip technology. And certainly that's something that ASML and ASM International, both big Dutch names, that we focused on.
Yeah, and we had the president in Phoenix, Arizona at a chip plant as well, because we know that American companies are looking to buy more American products so that they are less reliant on China, for example, trying to diversify that supply chain, given the ongoing COVID-0 related risk in that market. Even if we are starting to see some easing of those policies, companies still maybe looking to diversify that supply chain longer term.
Yeah, those geopolitical themes then no doubt linger long into 2023 and beyond. That is it for Early Edition. Surveillance is ahead. Tom, Don and Lisa will be taking you through the latest moves in the markets. We'll hear from Ellen Wald of the Atlantic Council, among other guests. This is Bloomberg.